Okay, good afternoon, everyone. Today I have the great Mr. Varun Badhwar. I've known Varun for almost 10 years now, since his days at Redlock. I remember meeting him quite early when he was just starting with Redlock. Had a good time working with him while I was at VMware. So Redlock got acquired by Palo Alto Networks, and then Varun was there for a while. So I'll have him do like a detailed introduction of himself. But Varun, can you just highlight that you've been on the both sides of the table on the M&A, like when you were selling your company and then while at Palo Alto. Yeah.
Yeah, happy to. Thanks for having me, Pramod. It's funny how this came together impromptu. You and I were just talking. I had posted about M&A ideas, and you said, let's do a live stream. And I think it's a great idea. Lots of people have questions in this space. I've been building companies for the last 16 years in cybersecurity, typically cybersecurity meeting large technology transformations and the implications to the future of software and security. I've had the privilege of going through a very successful acquisition with Redlock. We had founded the company in 2015. 3 years later, in 2018, it was acquired by Palo Alto Networks. Not only was it a typical big company acquiring a small company, it happened in the most unique of circumstances because Palo Alto Networks had just bought my biggest competitor 6 months prior, a company called Evident.io. And between the two acquisitions, there had been CEO changes. So Evident was acquired by Mark McLaughlin. Nikesh Arora had just come in and become CEO of Palo Alto Networks. Redlock was the first acquisition of Palo Alto Networks under Nikesh. And I think for him, he wanted to do acquisitions very differently. So I got courtside seats to seeing how he operates, how he kind of really digs his teeth into cybersecurity, but more importantly, creating this very unique structure where Endor ran. I keep coming back to Endor. Redlock ran as a kind of independent, if you will, what we call speedboat internally, but a product and business unit, creating a cloud security market opportunity for Palo Alto Networks like they had never seen before. And within that construct of building and running what we call Prisma Cloud business, I then had the opportunity to buy almost half a dozen companies kind of sitting on the buying side as we were integrating and evolving from cloud security posture management to cloud native application protection platform, or CNAP as it's now called. And I know everybody thinks about Wiz today, but if you ask the Wiz founders for the genesis, a lot of that was seeing the success Redlock and Prisma Cloud was having within Palo Alto Networks of building this platform. And lots of learnings being on both sides of the table, and happy to get back to the community and share what I know and have seen, from my vantage point.
Great. So let's just dive deep into this, right? So at Redlock, you were executing really well. You raised Series A, you had a Series B term sheet, and I think you also took the money in, and this acquisition offer comes in, right? So let's just think from two angles. Let's just start with this angle right now is, you're executing and you get a bid, right?
Yeah.
So how do you decide, like, you had the financing lined up, uh, you got this bid. Maybe let us start with, like, how do you actually evaluate this bid? Like, do you decide to entertain it? Do you decide to sell it? And then maybe a bit on the process side, like, do you engage with other bidders? Do you engage a banker? And then we'll come back to the second angle, which is trying to sell the company more proactively.
Yeah. Look, I always say this, the best outcomes happen when you're heads down building a great business and you're not kind of packaging up a company to sell. I'm sure we'll talk more about that in a few minutes. But coming back to kind of answer your question, to your point, we were in a position of strength, right? We had great momentum in the market. We were challenging Evident.io and many, many deals. We were kind of becoming an early market leader in our space, defining the category. We were the first to multi-cloud support. Everybody in the market at the time had AWS, and we had kind of leaned into AWS, Google, Azure early, and we had the financing in place. Luckily, I had an out clause on that financing, which allowed us to not make it a dilutive financing round. We can talk about that in more detail. But to me, frankly, when Palo Alto called again, to talk about us and get an update, my first reaction was like, "You're one of my biggest competitors now. You just bought Evident.io. Why would I talk to you?" I thought it was a bit of a hoax. And I think the way they kind of prove, and we'll talk a lot about like Nikesh's masterclass in acquisitions, because I think he's taught me a lot in this space as well, was kind of I just threw out this thing saying, look, if you're serious about it and you're saying you've got a new CEO, then great, I'd like to meet the CEO first before I have any conversations. And look, this is a $20 billion market cap company, but to me, the first filter of are they serious was, before any corporate development talks and business development talks, can I get the CEO there, sit eye to eye with me and tell me why do they think this is a good idea now? And we made that happen. Nikesh and I met for coffee. We talked a lot about just with the angles we're coming from, upbringing, values to startup building. And he told me that he thought cloud was the future of where Palo Alto Networks needed to make a bet, and he wanted a strong multi-cloud platform and thought Redlock coming together would be a great potential opportunity. At the time, we had this Series B that was scheduled to close in about a week from when this first meeting happened, and I kind of let him know. I said, look, we don't have a lot of time, frankly. And yeah, that was the story. The next day, Nir and a couple of other people were over at our measly little Redlock offices in a co-working space in Menlo Park, and we spent the afternoon just diving deep into product. That's how it all began. So, the takeaway for me there was, how do I know if somebody is serious versus they're just kind of doing what their jobs are? Pramod, you've been in corp dev situations too. Your job is to make sure you understand the pulse of everybody who's good in the market. My job as a founder is to stay focused on building a company, not get distracted with a lot of corp dev conversations per se, unless I have kind of strong interest that's qualified. And in my mechanism, the best way to qualify that is to figure out how senior of a leader is sponsoring this conversation within the potentially acquiring company.
Got it. And how did you actually tee up the conversation with your board? Like, you mentioned, you're in the position of strength, executing really well, actually beating Palo Alto, like the evident product, right? So how did you tee up that conversation with your board? And did you have to convince them that this would be the best outcome? Again, outcome for them financially, like, you can hold off, you can maybe try another. I mean, you see that problem right now because a lot of companies are holding back. The investors want bigger and bigger outcome. So this is very
Yes.
relevant right now. It's just, the
Yeah.
investors will say, I'll do a secondary if you want money, but don't take this
Sure.
offer. Yeah.
Sure. Look, first of all, it starts with having the right board around you and, board members that you can trust and align with. And I think our board members are very aligned on the overall mission that we had all embarked on the journey of. And that mission is very clear. We wanted to be the market leader in cloud security. And yes, we could have done it on our own terms as an independent company. But I think what we haven't discussed, but in the course of those next few days of conversations with Nikesh and Nir and other people at Palo Alto Networks, a big part of the vetting process for us was, do we think we can accelerate our mission? Because a lot of times, as you know, 9 out of 10 acquisitions, especially in cyber, go to die. They go by the wayside, right? Big company buys a small company, they tear the company apart. Engineering, 20, 30, 40 engineers go into a 1,000, 2,000, 5,000 person engineering organization, get lost. Marketing, 2, 3, 4 marketeers for this beautiful startup, compelling product get lost in a corporate marketing function of several hundred people, and you kind of lose the entity and existence of the company. I think when Nikesh pitched me this idea of running this as a separate entity, what he calls a speedboat, and the idea was the speedboat has to be built rapidly, iterated rapidly with a lot of flexibility, because all the things Palo Alto Networks used to do wouldn't necessarily be the things that Redlock had to do to be successful in the journey of winning the hearts and minds of cloud security practitioners who are not necessarily the network buyers. Was like, do we have a structure in place where we can take our mission, accelerate it, and have a higher likelihood of being successful at a faster pace? So that was one. Look, in all of these transactions, the most important thing to me after that is, what does this mean for the founding teams? But most importantly, I think it kind of, I lose my mind looking at some of the transactions that have happened in the AI world, where some of the founders have taken a bunch of money off the table and left a lot of employees out on the street. That is not how I operate personally. And I think from a high integrity perspective, making sure that was the structure life-changing, not just for the founders, but life-changing for every shareholder in the company. And then you look at it from a profile and return of investment for your investors, and all across the board, it checked off. We could accelerate our vision of what we were trying to build. We could become the market leader faster than ever. The structure supported that. I personally had a lot of autonomy on building this. It kind of became, having better access to more customers, more capital, and really a incredible brand like Palo Alto Networks to build it under. Frankly, a fantastic return on investment, time value to our investors in their portfolio. It was the biggest return for that particular fund for most of our investors. And so I think the decision was pretty easy. And frankly, when I said in the beginning, choose the right investors, and that's what's important, because when I went to them, not one of them pushed back on that. They just said, look, you put your blood, sweat, and tears into this company. If you believe this is the right decision, we trust you. I remember that conversation with Mark Fernandez at Sierra Ventures at the time, Deepak Jeevan Kumar from Dell Technologies, huge shout out to both of them. And that's what both of their perspective was like. We trust you to negotiate the best terms for us, you, the employees and shareholders in this company. And if you think this is the best direction, because we are going to take our money and we're out, you're the one who have to spend the next few years in this company. If you think this is the best outcome, then go for it.
Okay, makes sense. Let's just, this might or might not be true, but let's just assume that you gotten some offers for your current company right now, and right? How did you feel them? And like, obviously, you're still running the company, so you haven't sold the company, right? So can you just maybe give us a perspective on why didn't you sell, and and it just,
Yeah.
yeah.
Look, I think candidly on Endor, where we operate in the application security market, the last company that went public in this space in application security was Imperva. And I think the industry had a lot of hope and promise around Sneak potentially becoming the next public company in application security. And candidly, I think for a variety of reasons that I don't want to get into in this conversation, they likely will not be going public, or at least not anytime soon. And so from our perspective, the biggest opportunity here, and in fact, I studied the market pretty closely to say, is this a TAM problem? Is the market opportunity not large enough to build a IPOable business? Or is this an execution challenge in the companies that have tried? And I concluded this is primarily an execution and lack of appropriate product vision problem with the companies that attempted to and failed building a public company in application security in the last decade. And to me, having been through the journey of Redlock, selling it for incredibly successful outcome, what most would consider, and then building a 0 to 300 million ARR business in 3 years, what I'm challenging myself as a growth mindset perspective is, can we build now a 3, 5, 7, 800 million ARR business in application security? And I absolutely believe the TAM is there. I believe the AI software revolution, right? AI coding agents have become the number one enterprise adoption use case here and now. And the tailwinds that drive to the application security business and the need for most companies to have to modernize is just there. It's front and center. A lot of our competitors are in various kinds of trouble. They're either kind of private equity backed, kind of don't have the ability to grow rapidly, or they're constrained with leaky bucket problems, a lot of churn, not enough product innovation. And so for us, we want to capitalize on this. The other thing, Pramod, I've mentioned earlier, and I continue to say this, you never want to design a company to be acquired. A lot of times founders come to me and say, well, I think I want to get acquired in the next year. Like, what can I do? Like, look, we'll talk about the things you can do, but you also shouldn't be from a mindset designing your company, capitalizing your company, and executing on a plan that is a plan that is hopeful for acquisition. Because I feel like honestly, the best companies get bought; they're not out for sale. And I think there's a huge difference in being out for sale, in which case, kind of, you're a little bit on the position of weakness, versus when you're getting bought, you're in a position of strength, and somebody else is really interested in the outcome of getting you involved, and you have to figure out what those trade-offs are.
So let's just talk on the second angle, right? So let's just say you were at Palo Alto Networks, and Palo Alto did a bunch of acquisitions since you were there, right? The acquisition that they did and the acquisition that they did not do, right? So you must be getting a lot of. So I think maybe stepping into the shoes of those founders, right? Like, let's just say some of the deals that you did not do. Can you talk to us about like why they were not a fit?
Yeah,
Starting with maybe just on the company side, like sometimes it's a company and sometimes it's a fit, right? Like maybe
sure.
judging both of them. I'm more interested on the company side. Like sometimes the companies are just not the right size and not the right timing to get sold either. So yeah.
Well, I think it typically becomes a question of what are you in the market for, right? Is it you want talent? Is it that you want a best of class product in an area you're attempting to build but not able to build and execute fast enough and somebody else has done it better? Or you're trying to buy optionality into a new market. And I think the variables are quite distinct in all of them. Our belief at Palo Alto Networks, which by the way I generally agree with, um, across how the industry should think about acquisitions is, and I don't think I'm disclosing anything non-public. I think Nikesh has talked about this in several public forums as well. Is we typically think in cybersecurity, customers want best of breed. And if we can bring best of breed products and integrate them into a platform and give them best of breed and integrate it, that is the best outcome for our customers. So from that vantage point, when we were on the side of trying to make acquisitions and figure out what companies to go talk to and consider, we were looking at what are the big areas of gaps in our portfolio, of areas that we think would really expand TAM and make sense from a consolidation perspective. And then within those micro segments of markets, we would go understand and study what are the top one or two players in the space. We typically did not talk to player number 5, 6, or 7 in a list. We would typically talk to the top 2, 3 because of the belief I mentioned, right? Like we wanted enough early market evidence of this product or this team is capable of building a market leading product.
So maybe I just pause you on that. Like, so what is that traction? Are you looking for like 10 customers, 20 customers? Are you looking for enterprise customers? Are you looking for SMB
Look, it depends on the
customers?
segment, right? So when we're out in the market for container security, for example, and we ended up acquiring Twistlock, we were looking for what is the architecture and belief that we think, like who has the right vision on the architecture that will make sense now and in the future. We would then look at, of course, what kind of customers do they have, right? What segment of the market is that segment aligned with the segment of market that we sell to or want to sell to at Palo Alto Networks? Certainly, we were more of an enterprise business, and we want to make sure that there were enterprise customers able to use this product and like the product, love the product. And then we looked at the team's capabilities and just like the quality of the talent in the team and the density of talent that they bring, that would make sense for us. And then last piece of this definitely becomes cultural because you want a team that wants to come in align with what you do. And we spent a lot of time there really understanding and explaining to people the org structure before they walked in because we didn't want any contention and surprises of, how would the team be structured when they come in? What would the founders be doing? What would their focus area be? But yeah, like in the category, I'm giving a generic answer because, in the security for AI category, and I think somebody's asking questions here about that. The best companies, the ones that are leading are 3 to 5, 10 million in ARR. So they're all early, but what you're trying to discover is off that early segment, which teams are most capable to build and continue to build a great product, and what early evidence do we have that they have thought about the architecture the right way. So I don't know if that makes sense, but
Got
that's
it.
how about it.
One other question, just going back to the so in the case of Redlock, you did not reach out to new buyers and others like I know you said you met the Palo Alto folks and thought it was a good fit, but in general, what do you recommend to the founders? Is that something they should do? Yeah.
Look, the more leverage you have on the table, the better likelihood of the outcome that you want. And that leverage can come in a variety of forms. I don't necessarily think that leverage comes just in the terms of let me go shop around and find the best deal, because somebody else may pay you more. But the question would be, do you think you will succeed in achieving your mission and vision of the company there? Right? Am I optimizing just for the cash up front? Am I optimizing for, look, I got into this space because I'm passionate about solving a hard problem for a large scale of the market, and where can I get both? And so to me, it's a bit of an art. It's like dating, right? Who do you feel is the right partner for you? Do you have to always date 3 people before you decide to get married? Maybe some people will say yes, some will say no. My belief, sometimes the first one is the one is the right fit. and you feel like there's a connection, you feel like you have the right value system, you feel like you're aligned on how you want to operate, then you go get married or get engaged. So I think it's a bit like dating, right? And if you feel it's the one, then it's the one, and then you got to make sure it's the right partnership from there on out. But if you don't feel like it's the one and you're trying to figure out where do I get more leverage, then sure, go find a couple more companies that might get on the table. And of course, from a negotiation perspective, having a couple of options might be a little bit more helpful, but I wouldn't necessarily go optimize for that first. I would say optimize for where you think you will have the most likelihood of success, because only 1 in 10 acquisitions will actually work out. And you want to defeat the odds, just like you have been building a startup, defeating the odds of growing and scaling. You now want to defeat the odds of how are you going to go to a place and actually be able to continue to be successful.
Got it. So let's just go on the structure side, right? So what are the things that you negotiated? Like you mentioned some of the deal terms that actually matter, right? So one is like the headline price, like some things that go to the employees and the investors, and then you have some retention, then you have some leeway and some roadmap execution capabilities, as well as the company will invest in your, like, what matters the most, like
Yeah.
yeah.
So look, I'll park the thing that I've harped on a lot, which is understanding what is the acquirer going to do with the company, the structure, what will your roles be as founders, how impactful will the role be, will your teams be integrated, continue to remain together, will they be split? We've talked about that. That is super important in my opinion, because the acquisition is the start of the next phase of your journey, and you want to be able to be set up for success. That said, on deal terms, look, most smart acquirers these days know that they're acquiring for the team, and the most important thing is to make sure you structure the deal in a way where either if the teams have been around for a long time, you're going to typically insist on revest. You might be structuring more on retention if it's an earlier stage deal, because at the end of the day, I always say this, right? Investors have to show returns, and if you can give an investor in 6 months, 9 months, a 2x, 3x return, they should be pretty happy, like in a short, compressed span. What you need to optimize for is the people that are then going to continue to be on, building on and working on this product. And so I think from a deal term, overall construct, do what you need to get the kind of cap table structure in a way where you do right by your investors, because without your investors, you likely couldn't have built the business you have. Optimize and over optimize for you as the founders and the employees that are going to be with you and continue to be with you, because look, the fund will average out on across multiple companies. The employee only made one bet, and that bet was to come join you as a founder and work with you on a mission and a vision and a dream when you had nothing. So for me, optimizing for the next kind of the set of employees, the common shareholders, is really important. And there for me, it's really a few things. One is, how can you structure it in the most tax efficient way possible? Maybe you haven't hit your QSBS milestones, and can you then take a stock deal and make sure you continue holding stock? Because QSBS is extremely beneficial. So how do you structure the common shareholders in a way where they can be best optimized for taxes? 2, I'm generally hesitant for having milestone-based vesting that's outside of time, because when you're coming in, you just don't control the new environment, right? If somebody says sign up for revenue milestones, well, if I don't control the sales process, the sales team, CRO is reporting to somebody else, their strategy, their kind of priorities are different from me, and I don't control them, then that's difficult for me. So typically, I'm going to make sure that anything I negotiate with the employees and the founders is much more time-based than kind of milestone delivery dependent. That's usually important. So we talked about taxes, you've talked about the pieces. Usually you want to make sure that the vesting is reasonable. I will tell you, in reality, most acquirers, this has gone from 1 to 2 years of retention to typically they want the teams for 3 to 4 years. It is pretty standard, especially for earlier teams. Expect that, don't fight that as much. And then making sure you have the right protections in case, the acquirers terminate your employees for, lack of cause. Then making sure that you have acceleration on vesting usually becomes important. But yeah, I think there's a lot of tax optimization opportunities, and then the decision between stock versus cash in those transactions can be pretty paramount as well.
Got it. Um, and then after you get into the new company, right? Like you mentioned that, Nikesh told you about this speedboat, like keeping a bit independent, right? As you went through it, or maybe just as you got started, is that something that like worked for you, and do you actually recommend founders negotiating very hard, like a lot of time gets in negotiating like the price and like all of that, right? And then the transaction also has to close, right? Like so then you just closes and then you land up at an acquired, and a lot of times those things are not actually thought about, not discussed, right? Do you think that the founders should discuss that early on, and
I think
what
so.
part of the process? Yeah.
I can't tell you how much pain I've seen in the eyes of founders who get acquired and then they see their baby die, a slow, painful death in a large company. And they have to sit through that suffering and watch that suffering because they're locked in for 3 or 4 years, nothing's happening, yet they're stuck there. They can't go start their new company, yet they're not contributing to make an impact on what they signed up for. A lot of times people think, let me optimize for how much money is going to hit my bank account. But I tell you, in life, there's a lot more, at least as founders, like a lot of people, just impact is really important for many of us the way we're wired. Think long and hard about that. Do have those conversations up front, really understanding the structure and how you will succeed in the new company, because otherwise you're going to have a very, very painful next few years being there. And so I think cultural alignment, philosophical alignment, organizational structure, the more you can discuss up front, the better it is, because once the money hits your bank, you may buy a nice car, a nice house, and then what, right? Then you're going to still have 3 to 4 years to spend in this company that you're now a part of.
And then once you get into a new company, right, like there's a way you're executing at that startup, right? And you want to continue, but also expand in some other areas. So just to tell you one of the funny episodes at VMware, when you had acquired a company, the CEO came and surveyed all of our buildings, and he said like all this thing doesn't work for me because my my staff, they're used to like sitting together like a row of tables, more standing, all of that, right? And we eventually had to give him like a different buildings where he set up his own furniture and everything, so, because he wanted to really like maintain the culture of the company. Can you talk a bit about that?
Look, I think culture and integration is a series of compromises. The reality is the acquirer and the acquiree are going to be generally, no matter what you say, very different in their operating rhythms. One may be more in-office culture, one may be a fully remote culture, one may have a very Slack-heavy communications mechanism, one may have a different decision making. I think there are things you have to be prepared to compromise on, especially around that. And I think both sides have to give to kind of find the right structure of what works. So I don't get too hung up on that. I mean, I think if you're trying to find a company that is exactly the same culture as you, likely they're not large enough, because the larger the companies get, things do change and they have to evolve and process has to get introduced. And a lot of people in startups are allergic to processes, but I think you have to embrace it. And frankly, I think that's on the leaders of the company to really help that change management process. I don't get too fixated on that, but it's important to navigate.
Got it. And then on the acquiring side, right, when you had Palo Alto and you mentioned you acquired like Twistlock and PureSec and others, how did you think of integrating the platform? These guys may be coming with like different stacks, different,
Yeah.
CI/CD flows, and then there's a direction that the company wants to go long term. Like how did you manage the integration process? Yeah.
Yeah. This goes back to the avoid any surprises. We would spend a lot of time up front to really anticipate and plan and work out the architecture and how we would integrate these products. The most important thing for us is we had taken the Redlock product when we rebranded it to Prisma Cloud. One of the first things we had done is really modularize that platform in a manner where you could integrate offerings on the core data platform and have a extensible user interface. So what we essentially did is we almost thought about these startups as like microservices of features that would get introduced to the common data platform and a common UI layer. So we could have these teams, the Twistlock team, even for 3 years, 4 years later, operated as a container security team, and they were building the container agents, they were building the kind of core container specific vulnerability management, and all of that would integrate into the data platform and the UI in a manner where essentially as a customer, these were just microservices that were turning on and turning off. So I go back to the more surprises you can avoid with more planning up front, the better it is. So having a product strategy in place that the leaders of both teams commit to doing makes a lot of problems go away. Because I feel like in acquisitions, the honeymoon phases end really, really fast, and things get ugly or have a tendency to get ugly really fast because the appropriate expectations were not set up front, and the appropriate planning did not happen up front, and the appropriate buy-in between the different teams didn't happen up front. So I think that's super important.
I think there's a lot of questions on just the M&A, right? I think coming back to initiating M&A, like you see a lot right now. The founders, they start with a niche. They're doing something very, very small, right? And they get like 10 to 20 customers, and then
Yeah.
then they have to raise Series A, Series B, and then I think what's happening with security, just like everything is like so crowded right now. Like there are like 10, 20 companies in every space, and then the growth stalls a bit. I mean, some of the TAMs are large also, right? But it's still like the market is very competitive with incumbents and others.
Yeah.
How do you think of M&A in that case?
Yeah. And I think there's some questions here Senthil's asking, which kind of ties to it, right? As a startup, you always want to be thinking about the channel, the mechanisms in which you can produce a better together story for a customer, right? So in my case, as an example, at Endor, with the business we're in, knowing that 80% of the world's code lives on GitHub, it was really important from day one to have the right kind of partnership with GitHub and eventually with Microsoft, because it's a logical place to connect, right? With Redlock, a lot of the logical places were the cloud providers themselves. In some cases, it's the complementary solutions in the stack that customers want to integrate with. So I almost start this as a first principle conversation, that what would be the most logical things to the left of your product, to the right of your product, above your product, and below your product. So if you were to build a solution outcome, what are the likely things that a customer is going to want to integrate into and with? And starting those alliance conversations, technical partnerships, product integrations, and potentially pushing towards co-selling and integrated selling opportunities is the right way to kind of decide and eventually kind of build the roadmap of partnerships. Because then you ask the question of like, hey, who are the companies? Who should I be talking to, hearing from? I think it's the line of sight that's 1 degree left, right, up, and down to your product, that you need to always stay very close to that ecosystem. And sometimes those are startups. And, look, startups with partnering with other startups is fine. You do it when it makes sense. But usually, if you can find the largest platform in and around your vicinity and kind of creating the right partnerships and awareness and conversations there is the right way. Because turning the question around, how do the teams in corp dev know who to be keeping a pulse on? Yes, of course, they're studying Gartner, but frankly, these days, a lot of the research from Gartner is usually the Magic Quadrant part is all the legacy players. Everybody new is usually outside of the scope. So I think they're talking to a lot of their customers. A lot of the larger players are talking to lots of VCs and trying to keep tabs on the up and coming companies. And you could do that certainly by building more organic product partnerships and go-to-market partnerships as well.
So this is one question that I think a lot of founders ask, right? How much time do you spend like talking to corp devs? Like, a lot of corp devs are active. They come and sometimes you're not ready, you're too early, and you don't know how much to share, right? What are your like being on both sides, and like this is your second company, like let's just say somebody again from Palo Alto, corp dev reaches out to you, and what do you do? Like, even if you don't want to sell, like, do you entertain that call? Like, what do you share?
Yeah, look, I think first and foremost, I identify if Palo Alto Networks is in my 1 degree up, down, left, right? Does it make sense? And usually for me, I'm trying to navigate that conversation more from a, hey, what's your revenue? What's your this? What's your that? To here's where the synergistic integrations are, and can I get introductions to your product organization, your go-to-market organization to go build up a story? So I'm trying to leverage the corp dev opportunities to kind of navigate into is there an opportunity for me to sell with you or sell to you my product? That's usually where I will personally take these conversations. If you're outside of my spectrum of the first degree where I can logically understand why would I want to spend time with you, I generally avoid those conversations. And the other thing, if you want to kind of filter, is just like you do with sales, you're trying to discover the pain point of your customer. Why do they want to talk to you? Why? Ask a lot of questions. If you're on a call with a corp dev team, you should be spending 60-70% of your time in the first call asking them questions about why they're interested in talking to you. What is their thesis about the space? See how prepared they are. The more they can answer you convincingly about their thesis of the space means they actually have a well-formed assessment of the market, versus if they're just coming and asking you, questions, and you're spending 80% of the time educating them on the market, then they're very early in the learning process. So I think you're trying to suss out, where are they in the buying and information gathering cycle, and also understanding and asking the question of like, who is the executive sponsor on their side, right? Are they just doing market research, or has their chief product officer or CEO asked them to go study the market? Who is the person? And seeing if those calls will proceed, I would usually use the qualifying piece of like, hey, then can we have that executive sponsor align with us, in the next call or the call after? I wouldn't do more than 2 calls with Corp Dev without an executive sponsor from their side getting involved, coming and having a one-to-one conversation with you, the CEO, to try to help understand, what are the challenges they're trying to navigate and what is the opportunity at hand.
So a related question, right? I asked you about corp dev guys reaching out to you, and then how about like you reaching out to like this executive sponsors, right? Like let's just say GM of a business unit or a CEO. Does that outreach actually help? Because I think the question that founders ask is like, they want to get acquired, but they don't have this relationship with the executive sponsor. The GM, CEOs don't know them.
Yeah.
Then they start hiring bankers, but the bankers connect them to the corp dev people. Is that something that do you recommend? Like, has it worked for you? Is to maybe just proactively just beat a lot of this ecosystem, like as you mentioned, like from a partnership ecosystem perspective, just being very proactive, even though you don't see anything short term.
Yeah, look, I'll give you an example, and this is less M&A, but just building the right relationships with that first degree of companies you need to be involved in, as I said, for Endor. 80% of the world's code lives on GitHub, so that relationship is really important. I have personally met with Thomas when he was the CEO of GitHub. I have personally sat down and spent an hour with Satya at Microsoft. And so your investors should be able to help you navigate. Now, did this happen overnight? No. But it took a lot of work organically, working with the teams, product organizations, working with sales, identifying the joint opportunities between the two companies, and then kind of taking a point of view up to the leadership, and then getting their executive alignment and thoughts, and just picking their brains on how they think about stuff. So absolutely, I think a big part of the CEO and founder's job is to be 2 steps ahead and 3 steps ahead, and thinking about how do you organically grow these relationships that could be beneficial to you over the years.
Got it. I think one other question is on this Gartner and research analysts, right? Like, is that something you deal with? Do you think that's worthwhile from an M&A part? I mean, I personally don't think so. I mean, sometimes the acquiring companies do talk to Gartner and ask like, hey, what do you recommend in this particular space? So,
Yeah.
but again, this is not free.
Yeah, I think most of the early indications typically come from the VC network. I think the corp dev teams are pretty plugged into the VC networks, and figuring out who's doing well, what are they doing, what space are they seeing emerging companies in, is usually a better source of information for tech companies and tech company corp dev teams and founders and CEOs. That's how I've personally seen a lot of them learn.
Got it.
There's a couple of questions I think I saw here really around Pramod, on the valuation, like how do you peg a number? I think Anupam was asking about why 750 million for Protect AI, and then I think there's a question on how do you even come up with a multiple for an early stage company. Look, I think it's very interesting. There's typically stages. I peg round numbers. This is no perfect science, but I feel like typically if you're under 10 million ARR, Series A, Series B company, you're kind of probably more of a technology/strategic multiple. I feel like once you get later stage, you get past 10, 20, 25 million ARR, and especially if the growth is slowing down a little bit, then it's much more uphill battle trying to get a technology multiple. Then you're kind of looking at more of a revenue multiple. Look, there are two ways to think about it, right? A lot of times at the early stage, people will be like, oh, you're a million ARR, you want 100 million, that's 100x, you're crazy. I think the other way to think about that is if you plug in the right technology, the right team at the right time into a platform, could you go from single digit millions to 100 million ARR in a short period of time? I'll give you a real example. I thought we were absolutely crazy when Nikesh told me that, hey, I want you to take Redlock to 100 million ARR in 1 year here. I said, what's wrong with you? Like, this can never happen. He's like, no, we're going to do it. That's the plan. Um, and we came pretty close to that in 1 year, right? From single digit millions to 100 million. And so if you then go look at what did they pay for Redlock, and that was a cheap acquisition once we got to that 100 million ARR mark, right? So a lot of times it's the potential, the future potential of what I have a line of sight to I can do in the next 12, 18, 24 months. And then how do I kind of put a value to that? A lot of other times in earlier stage deals, it's, what is the return on investment that investors will be happy at? And then how can I load up much more on retention and equity for the team? So I don't know if there's a very formulaic way of coming up with earlier stage company multiples and valuations. But that's why if you're in a position of strength, you can really lean in on that kind of technology multiple versus, then you see acqui-hires, right? Typically the acqui-hires with large technical teams, non-AI space. I don't even want to comment on the AI multiple per acqui-hire per employee, but typically you can get $1.5 million per employee in the acqui-hire scenario, in which case it's more about the people, and then you might pivot to working on some related but not directly the same product that you have. So I think these transaction values are all over the place, depending on where you are.
Yeah, now I'll also add one more comment. I think that's why I think finding the right partner is very important, right? So in this case, like Nikesh is quite aggressive, quite ambitious. He wants to take it to the next level, right? So you need to find the right partner. So as you're evaluating acquirers, I think, just don't get infatuated with the top line number, right? I think the other person on like who's going to actually be your like business partner has to be ambitious and also in the right position and the right power in the company, right, to take it to the next level. And that also dictates like whether this acquisition is going to become successful or not, right? If that person basically like once you know that I mean, hey, 100 million doesn't make sense, but if the person actually has a reputation of scaling the companies in the past, then it's possible.
Yeah, totally.
Yeah. So just one last question. Looking back, right, and also like your current journey, what is one thing you think founders are not doing well to maximize the value in case of an M&A? Like what is one thing that they should be doing?
Just heads down, focus on building a great company, a great product with the best people in the great market. Everything else is a distraction. Meaning, I think too many people start wanting to take a lot of shortcuts in building the company, hoping somebody acquires them and takes their pain away, and then everything becomes somebody else's problem. And I feel like there's not a lot of acquirers in the market looking for that kind of an acquisition. People want the best teams, the best potential, even if it's an early product, the best potential, best team, and a bold vision to take on a big market. And so I think if you just put your heads down, focus on those three things, good things will happen around you.
Yeah, and also I'll just add one more thing. I think founders don't emphasize that much. They feel like, I build a product. Let's just say like there was a question about product AI, right? Some people might say, hey, I had a product exactly like product AI, right? But what's differentiates product AI is also building that brand and that hustle, right? I think that is one thing that founders don't take very seriously. They feel like, yeah, I build a product, I get a few customers, I should get the same outcome, but you need to really build a brand and the team as well as you mentioned.
Yeah, and that brand has to be that generally this is one of the smartest teams in the space building a really great product. That has to be brand surrounds you because the acquirers want and will likely and hopefully pay a premium for that, right? Great people building a great product, which the way you amplify that is with a brand.
Yeah. Yeah, I know you had to rush, so thanks a lot for your time. Thanks everybody who joined. I will post this on LinkedIn. I will do a summary of all the questions and answers. Yeah, and look forward to engaging more in future.
Yeah. Thank you so much for doing this. I loved it. All right.
Bye.